On March 4th, Wall Street Journal chief economics correspondent Nick Timiraos warned that after Powell's term ends in May, the Federal Reserve's independence is facing its most severe challenge since its founding. The Trump administration is applying pressure through a three-pronged approach: judicial intimidation, personnel infiltration, and institutional dismantling. Combined with the preemptive concessions of successor nominee Kevin Warsh, monetary policy risks becoming a political tool. Once expectations of central bank independence collapse, the consequences could be irreversible. The Trump administration's pressure on the Fed has crossed historical boundaries, escalating from rhetorical criticism to judicial and personnel warfare. In January 2025, the Justice Department subpoenaed Powell citing building renovations, effectively trying to force him to capitulate on rate cuts. Former Treasury Secretary Yellen called this an unprecedented weaponization of the Justice Department. On personnel, Trump has already appointed 3 Fed governors and is attempting to remove Governor Cook on grounds of mortgage fraud. If successful, his appointees would hold a majority on the board. On the public front, he has repeatedly attacked Powell for cutting rates too slowly and warned that if Warsh doesn't deliver cuts after taking office, he will face legal action. Powell fought back by publicizing the subpoena and rallying congressional support, forcing the investigation to cool. But that victory relied on his bipartisan stature, a card unlikely to be played twice. The institutional safeguards of Fed independence, self-funded budgets, 14-year governor terms, look sturdy but have critical flaws. Former Fed economist Claudius Sahm notes that institutions shouldn't rely on individuals. Powell's departure will take with him the bipartisan trust network he built, leaving the institutional defenses questionable. If Trump's appointees gain a board majority, they could potentially remove all 12 regional Fed presidents with voting rights, something unprecedented in the Fed's history. Loss of independence often happens through a quiet process: presidential pressure, chair concessions, congressional inaction. Johnson and Nixon both played this game. Trump's nomination of former Fed Governor Kevin Warsh to succeed Powell is fraught with tension. Warsh has publicly endorsed Trump's criticism of the Fed, marking him as a political compromise. Once in office, he'll be pulled in 3 directions: the president, the markets, and his colleagues, leaving little room for independence. If he resists aggressive rate cuts, he could be marginalized by the board or face judicial probes. If he caves, the Fed's credibility is destroyed. Over 70% of economists worry independence will erode under his leadership. If markets see him as a political puppet, it could trigger a chain reaction: a weaker dollar, surging Treasury yields. Whether his nomination even clears the Senate remains an open question. The damage from a compromised Fed goes far beyond the path of rates. Once the public believes the chair is a political enforcer, it's a broken windows effect. The entire trust foundation of independence crumbles. In the short term, policy uncertainty spikes, volatility rises, and growth stock valuations get squeezed. Long term, the risks: runaway inflation, a weaker dollar, global central banks dumping treasuries, all feeding back into U.S. fiscal problems. Nixon's political pressure helped fuel the 1970s inflation surge. Threatening a sitting Fed chair with criminal investigation is even more dangerous. It could kickstart the politicization of monetary policy. A compromised Fed could also accelerate global de-dollarization. Going forward, 3 key indicators to watch: the composition of the Board of Governors, Warsh's policy signals, and actions from the judiciary and Congress. On investment strategy, near term, increase cash and gold. Avoid richly valued growth stocks and long-dated treasuries. Medium term, focus on energy and defensive sectors, and watch for repricing if dollar credibility is damaged. Long term, if Fed independence erodes persistently and de-dollarization accelerates, commodities and emerging market currencies could benefit. Powell's departure takes with it not just his title, but the 8-year bipartisan trust moat he built. Trump still has 3 years left, plenty of time to reshape the Fed through personnel moves. Warsh's preemptive concessions put the independence defenses on the brink. The real risk isn't a single rate cut. It's the collapse of market and public belief in central bank independence. Once that expectation sets in, the impact will ripple far beyond the U.S. touching the entire global financial system.